Hi guys, Boris Dorfman, LBC Capital Income Fund. I've been away for a bit, but I'm back and I want to talk to you about inflation, economics, real estate market, and I want to talk CPI today specifically. I want to explain to you what CPI is, how it's calculated, and how we can forecast going forward. CPI is Consumer Price Index, and it's one of the two measures of inflation. Consumer Price Index is the money you guys spend every month on your necessities. It's called basket of goods. You have rent, you have healthcare costs, you have car payments, insurance, gas, food, movie tickets, and month over month the report comes out pricing the same basket of goods on the monthly basis, on the yearly basis. Okay, so biggest chunk of that is rent. 40% of CPI is rent. So that when the rent goes up, CPI goes up significantly. So when you see all this talk about inflation, all this talk about raising interest rates to curtail that inflation, the government looks at Consumer Price Index, monthly and yearly. Over the past year, CPI have increased dramatically. This report comes out every month, and every month this year substitutes a month from last year, and all the months get added up for the yearly CPI. So we're looking at the yearly CPI when the report comes out, and the target was 2-3%. Today, last month, the CPI was 8.2%. Today, it dropped from 8.2 to 7.7% year over year. On the monthly basis, the expectation was 0.6%, but the real number came in at 0.4%. So the inflation was less than expected. That's why you see all the markets react the way they did. The bond market reacted severely, and the rates are going to come down today and on Monday. And also the stock markets went up because this is positive news for the markets. Inflation is the biggest thing on everybody's mind. Inflation goes up, the Fed is going to continue raising interest rates. So yeah, it's a big thing. But how is it calculated, and how can we look into the future? So I'll give you the chart from August of 2021. On a month over month basis, so in August, CPI went up by 0.3%. If you annualize it over 12 months, it would be 3.6% a year. September, it was 0.4. October was 0.9. So it really started going up from October, 0.7, 0.6, 0.6, 0.8 in February, 1.2 in March, 0.3 in April, 1 in May, 1.3 in June, right? So you add these all up and you adjust it, because CPI revisions come out after a few weeks. Last month, the CPI was at 8.2%. In September. In October, what happened, we got a 0.4% reading, and October of 2022 substitutes October 2021. Okay, so we had 0.9 came off and 0.4 went instead of 0.9. Okay, so we got 7.7, 0.5% yearly drop. So next time the numbers come out in December for November, November was 0.7. If the next number is going to be less than 0.7, yearly number is going to drop. So this is the number you watch yearly CPI. It should, I think last month it peaked, right? Because we're going to see lower numbers substituting previous numbers, especially when you get into March of next year. Let's say the reading comes out at the same 0.4, we're going to trade with 1.2, we're going to see yearly CPI drop by 0.8%. Again, government is looking at 2-3%, but for purposes of today, the minute we see CPI reading on under 6, the federal government was going to stop raising rates or even start lowering rates. Okay, so this is a quick lesson on CPI. We see lower CPI readings going forward just because we had higher last year. And if we stay around 0.4, 0.5, 0.3%, we're going to see CPI significantly, if you annualize 0.4, it's going to be 4.8% a year. That's a very manageable number. 8.2, that's obnoxious. 7.7 is also extremely high. You're going to have CPI coming down, and as CPI comes down, you're going to see Federal Reserve increasing rates at a lower pace or not even increasing. So we shall see what's going to happen, but today was the beginning of something good. Keep in mind, all federal action, everything they do, textbook says it takes 9 months for the markets to react to it. So they had a 0.75% increase in September and another 0.75% in November. So figure 9 months from September is going to take us to June. When we get to June, our CPI is going to be lower. Figure markets are going to anticipate it a few months before. So if I would be a betting man, probably April or May of next year, we're going to see significantly lower interest rates. So how does the economy and real estate market going to take this? It's still a little bit difficult to forecast. The amount of money that was printed was insane. So people still have money. I just came back from Vegas. People are still traveling. People are still spending. People are still gambling. But hopefully that amount of money is going to trickle down through the system. People are going to spend less, and we're going to see lower interest rates in the future. Obviously, we may see recessionary signs. We may see recessions. As far as the real estate, I'm pretty optimistic. We will see imbalances. We will see people that need to sell, and they need to sell fast. And we may see 10-15% price drops on certain transactions, but I don't see across the board significant drop in real estate prices. I kind of see them flat with some opportunities along the way. But anything prime neighborhoods, prime properties, you're still going to see some competition because people like luxury in today's market. I just read a report on commercial real estate. Anything that's new, low maintenance, is getting swooped up. Value add, not so much now. There's a lot of money, they want low maintenance. They'll take lower yield, but they don't want to take care of the property. Same thing for owner-occupied properties. People with labor costs up and material costs up, people don't want to remodel their properties. So properties that are ready to move in, properties that are new construction, they kind of hold they hold the value a little better. And of course, I'm talking about California primarily. Anyway, guys, subscribe to my channel if you haven't already. Thank you very much, and I'll see you next time.